Hey there, and welcome back to SOS Stories of Survivors. Today, we are talking about financial survival and mental survival. Picture this: Washington, D.C. just passed this huge stimulus bill, so big that our national debt may raise to $53 trillion by the year 2034. That's absolutely mind blowing. Today, here on SOS Stories of Survivors, we are welcoming my friend and financial guru, Michael Litt. Michael was the partner at the FrontPoint Partners, which is the hedge fund that was featured in The Big Short. He's been advising institutions and clients, and he's now sharing what he sees for the market going forward and what risks and pitfalls are out there. So please join me in welcoming Michael Litt. And also, something you guys should know, he is going to be premiering on SOSradio.live, his show, That Guy Is Lit. So stay tuned to hear more about that. Welcome, Michael. So glad you could join us today.
Thank you, Serina. It's good to be here. And it's a fun topic to talk about because there's a lot going on.
Oh my God. I want to get right into this. But first, I think our listeners want to know about you and your background. You've said you've been around the market since an early age, probably like 15 years old. Were you really running trades for your uncle on the mercantile exchange?
Yes, I remember this movie they had way back in the day called the Oliver. And there was a character in Oliver called the Artful Dodger. And he took Oliver running around everywhere in London and taught him the streets and, they were street urchins and they taught him the ways of the streets. Well, when I was 15, my uncle brought me down to the mercantile exchange and had me running paper around to different pits and putting trades in for him. And they were in like the Deutschmark currency, which we'll talk about later actually, and financial futures, treasury securities, and eventually the S&P 500 futures, a lot of meats, trading feeder cattle or pork bellies, things you hear about. But actually at 15, I was running around like the Artful Dodger on the crazy, loud, sort of insane floor, learning how to trade at the age of 15.
That's absolutely incredible. And what lessons did you learn about risk and discipline in those early days?
It's a good question. It's interesting that markets moved what they call upstairs. So people were trading with electronic screens, which is how everybody trades now. And for a long time, they'd call each other on phones and execute trades. Now they just execute, electronically. But what I experienced there when my neuroplasticity was impressionable was the body language of people as markets were moving. And so you could really see sort of into the soul of markets and how people behaved as markets moved. And so that's very much imprinted on me, and it helps me a great deal in seeing things that others might not be able to see.
Wow. I mean, I was a financial advisor in my prior life. And when you say body language, you learn to read people. And body language is a huge defining characteristic. I find that really amazing and really impressive that at the age of 15 that you were able to connect with that. I applaud you for that. I have to ask you, I mean, you were on the mercantile exchange floor. Then you went to Morgan Stanley and derivatives, and then to FrontPoint as a partner. Was there a thread that connected you between those positions in your career?
Yeah, interestingly, the derivatives, working in first asset management and then the derivatives group, connected back to the financial futures and the options on the futures that were traded. So understanding derivatives came from that original, because futures by definition are derivative securities. And so that experience led to that, and combining understanding what we call non-Delta One securities, which is an option. An option is not owning, say, Apple stock, right? You own an option on Apple stock. So it might go way up or it might go to zero.
Right. So it's an option to either buy or sell, right?
It's an option to either buy or sell Apple stock. but it has its own life. It's different
Hmm.
than it's related to, but it's different than the stock itself. So there's a kind of mathematical relationships between those derivative securities and the stock or the bond itself. So that those were related. Um, Going to FrontPoint had to do with understanding a lot of different securities markets at that point and being able to um, write about, write research papers, and allocate amongst the different investment strategies we had. And that's what I was doing, was allocating capital to different teams when opportunistically, when their opportunity set was most attractive in our view. Now that was a judgment call,
Right.
but understanding all the different global markets and the different securities in those markets was required to be able to make an informed decision on with respect to allocating capital. And we ended up ultimately, FrontPoint peaked out at, I don't know what it was, 13 or 14 billion dollars, which was a lot
Yeah.
for a hedge fund back in that day, and made us one of the larger hedge funds out there at the time.
Well, let's talk a little bit about that. FrontPoint is the central character in that movie and book, The Big Short. So, what did that movie slash book get right about FrontPoint and about um, the analysis and structuring behind what went on there? And talk about your role in all of this as well.
Well, the first thing I would do is give Michael Lewis a lot of credit. He does his research when he's writing a book, and he found out everything that we were thinking and doing. And I think he probably did with the other two funds. Michael Burry is at one, and the two guys in the garage, Browning Capital in Colorado, are the other one. But he learned, he went and did his homework on. And I will say that the book quite accurately reflects a lot of what went on, not only at FrontPoint, but in the marketplace and with respect to how people were behaving. So I think the first thing is that the book got it pretty much right. The movie didn't stray that far from the book. And one of the interesting things is Michael Lewis said with Liar's Poker and Moneyball, they actually had him on the set. They had him involved in some of the script writing. With The Big Short, he was not at all involved.
Huh.
But he said, in his opinion, it turned out to be the best of the movie. So he said, maybe I shouldn't be involved. But they had to leave a few things on the cutting room floor in terms of details, but they pretty much stuck close to the book and executed, in some ways, capturing the excesses of the people in the marketplace and the regulators, the government officials, the origins at Salomon Brothers with Lou Ranieri. I think they might have captured some of that even better than Michael Lewis did in the book. So I give them a lot of credit for getting most of it right, frankly.
Wow, wow. I I've got to like educate our listeners a little bit on The Big Short. I mean, this was during the financial crisis that took place back in 2008, 9, 2000, I want to say 7, but yeah, it's 2008, 9. And The Big Short really talks about what some of the catalysts were behind it, and the housing market, and there's a story circulating out there that you actually authored a piece of research that was one of the reasons why FrontPoint actually did the trade that they did. Can you explain a little bit about that?
Yes. My partner, Gil Caffrey, and I had observed that there were a lot of excesses in terms of the way investors were behaving. And you can see excesses when they are happening. The most difficult part of taking advantage of that is knowing when that's going to end, when the party is going to get broken up, if you will.
Yeah.
We wrote a piece called The Great Compression, which was about the compression of risks credit spreads, which is how much you get paid to take risk in owning a credit instrument or lending money to somebody.
Right.
So people were willing to lend money for very small incremental returns, which didn't seem consistent to us. And it was really driven by these leveraged securities. There was just so much capital being put into the credit markets that it was essentially driving up the price of the bonds and driving down the credit spreads, hence the Great Compression.
Wow.
And we saw that this was going to end. We just didn't know when. And yes, that was a widely read research piece, and people still to this day go back and say it was the story was told in the paper, The Great Compression, what was going to happen. But I'm telling you, we couldn't know when it was going to happen.
Of course not, yeah.
And we didn't. We were a little early. Just in real life and in the movie, Michael Burry's character, the Michael Burry character, right? Who's played by Christian Bale, right?
Right.
He is so early that he has to like essentially block calls from all his investors, right? That's the real risk of trying to predict something like this. That's more real than anything else in the movie.
Well, yeah, I mean, timing the market, right? I mean, the writing is on the wall a lot of the times, and you could see things, going to happen, but then, something else will come and blindside it, or, a different, something else will emerge sociopolitically or what have you to alter the timeline on what you're expecting to happen. So that's a real concern. Is there a durable lesson that you'd want investors to take away or not forget from what happened between 2007 and 2009? Only because we all, as humans, we have short memories, but history repeats itself a lot. And I'm just wondering if you have any thoughts on that.
It's a good question. I think there's a general lesson, and then there's a specific lesson. And the general lesson is that excesses occur, and in the period building up to them, everybody believes in whatever the mantra is in the marketplace at that moment. And everybody is willing to go along with the crowd. It's never any different. It really isn't. It was that way with the .com. It was that way with the credit markets. Okay. It was that way with growth stocks in 2019, 2020. And people don't realize we had a crash in growth stocks in 2021. There are many growth stocks that went down 80 to 95%. Crypto went down. And a lot of them have not recovered anywhere near. AI stocks and extremely mega cap AI stocks have. But that masks what went on between 21 and today, 2025, in terms of the losses there. We may have excesses at this moment in time now, but again, people will still go along. In terms of the specific lesson, it has to do with housing. And we'll get to that today as we get into our discussion. I'm going to make a point about the very well-intended social policy driver that led to the excesses in subprime mortgages and the credit markets, and how it relates to a housing market today.
Yes. Let's start talking about. I mean, you have a slide up on the screen right now. Can you talk about what this chart is showing us? I mean, I see, it's referencing the new stimulus bill that was just passed. I see a lot of debt on there. So let's get down and talk about this.
Right. I mean, everybody knows about OBBBA, which was passed in July by Congress and the Senate, and it barely passed. There was a lot of negotiation going on. Even today, I learned about an element of this that was taken out at the last minute that had to do with drug pricing. Right. There were a million things in this bill. Some things stayed in, some things got taken out. Some things are good policies, some are bad. At the highest level, the blue bars in this chart represent the tax stimulus or cuts, the net tax stimulus or cuts that are estimated to occur because of the bill. So beginning in 25, there's a small increase of $100 billion, but then there's a $500 billion or $500 billion every year that are tax cuts. Those are reductions in revenues to the government. So they add incrementally to the deficit. In total, we are going to add, as we'll see in a moment, somewhere between 2 and 3.5 more to the deficit over the next 10 years because of the bill. And the baseline additions to the deficit were projected to be 17.5 billion. So now they're projected to be 17.5 trillion. I'm sorry.
That's okay.
And now they are projected to be 21 trillion by most estimates. And that could vary by a trillion or a trillion and a half. But you're going to be somewhere between 20 and 23 trillion dollars of incremental debt between now and 2034. Now, where does that money go? Because some of it's going to households. And then we have another thing going on, which are the tariffs. Right? So two big economic events occurred somewhat simultaneously. And so in this chart, the orange represents the OBBA either increase in taxes, which is negative below the horizontal line, or OBBA being a tax cut and more net household income, for the orange bar being above the line. One thing you'll notice about the orange bars, when you go to the right, there's very large positive $12,000 per household, and that's for the top decile of income earners. You would expect that to a large degree because they pay the largest amount of taxes. What is surprising is that tax benefits fall away pretty quickly as you go from right to left. So as you go from the 9th and 8th decile household incomes, they still do pretty well. By the time you get to the middle class in the 4th through 7th, they're getting a little bit, but the blue bars, which are the tariffs, are all below the line. So the tariffs, which get paid at the customs house, are going to be paid by the consumer.
Oh, absolutely.
And so all of the consumers are paying for that. When you add the either net increase in taxes and the what you pay for tariffs, you get the black dot. So net of the two, the only households that have a net benefit from the tariffs, the combination of the tariffs and OBBBA, are the top 10% of income earner households. The 80th to 90th percentage households basically break even, and the lowest income up to the 80th percentile are essentially going to be worse off.
That's always typical when you see sometimes of these bills where they hide everything and it makes it appear like, oh, this is going to be great for everybody, but really it's supporting the wealthy as these numbers show.
This next slide actually just shows the incremental addition to the deficit. Now, you'll hear some people who are I always have to take a neutral stance politically, because if you're in the business that I'm in, where you have to make money by what you believe about the markets, right? You ignore politics, or try to ignore politics.
Yeah.
You look at the data, you look at the impact of the policies. Some people will estimate that the incremental addition to deficit is 3.5 trillion over 10 years. Some people will say it's 3 trillion. A very administration-friendly group called the Tax Foundation, I put them on there because that's about as friendly a set of assumptions as you can make about OBBBA. They think it will add 1.8 trillion.
Wow.
So somewhere between a very rosy, looking at the world through a rose-colored glasses, you could say, well, it's only adding 1.8 trillion, and a lot of the other estimates by Penn, Yale, the Congressional Budget Office are more sort of 3 to 3.5 trillion. So there's not a lot of argument, but we do get to $53 trillion in debt 10 years from now. And there's a little asterisk here, because at the bottom, the Social Security trust funds are estimated to run out in 2033. So we're going to get to an intersection where we simultaneously are on a pay-as-you-go with Social Security, and we have $54 trillion in outstanding debt.
That just blows my mind, okay? Because, I mean, we've always suspected that we were going to run out of money just based on the population, the baby boomers, and the amount of money that was going into Social Security versus the amount of money that would be coming out. But with all the growth in the market, I know that they put some Social Security into the market or they've done some hedges and they've made it easier for people to save for retirement by increasing the minimums. But what does that mean for consumers or for the everyday person that's hoping to retire one day and take some of the money that they've put in their entire career?
Well, what it means is that you have to save more for your retirement
Yeah.
because they are we're going to have to deal with this deficit, right?
Right.
And the fact that Social Security will not have a funded pool of assets sufficient to pay for Social Security obligations beyond this date. One of the consumer is actually very smart. And the consumer is sort of picking up on this now. And what we see in consumer sentiment surveys, which is one of the things that I watch, is that they're quite low. In fact, the number between 55 and 65 that we've been seeing is sort of a recession level consumer confidence. We are not in a recession, and the probability we're going into a recession is still not that high. Right? The economy and earnings seem pretty good, though we're seeing elements of the economy begin to slow down at the moment. Okay. So the consumer is seeing all this, and we've been in a good economy for like 3 or 4 years now, very good economy. And I'll talk a little bit about why that's true and why the consumer actually had been kind of in a pretty good place, but is now sort of reconsidering. Okay. One thing that you should keep in mind is that when we look at gross domestic product, and when the person on CNBC or the nightly news says, "Oh, the economy grew 2.3% last quarter,"
Right. What does
what
that
they
mean?
mean is the gross domestic product on an annualized basis increased by 2.3%. Right? Now, the biggest driver is actually consumption expenditure. It's almost 70% of final demand. Investment expenditure by businesses is really only 13%. Government spending is 22%. And net exports are negative 3%. That's because we import more than we export.
Right. Right.
So they subtract they are a net reduction to GDP.
I have a question. I mean, do they exclude certain numbers from GDP to manipulate the numbers? You always hear people say, "Oh, well, this is X gas and oil, or what have you." What do you think about that, and what's your take on that?
The numbers we publish on economic data, on labor statistics, that was in the news as the person who calculates the jobless numbers lost their job over that. They're not political. They're not, they are the Federal Reserve and the Bureau of Labor Statistics, the International Supply Managers, the University of Michigan survey. Those are pretty clean data.
Okay.
There was data coming out of China that we had some questions about, and China has stopped publishing a lot of data because they didn't like the answers they were getting. Okay. Now, hopefully we don't go that direction because I use a lot of that data. So I will be disappointed if we stop getting data. So the question is, how do we pay back all that debt? And that's why the consumer's a little hesitant here. They're pretty intelligent as a group. There was this movie back in the day with Chevy Chase called Fletch. And there's a scene where he's at a country club and he walks into he's not a member, so he walks in and he orders a drink, and the fellow says, what account is this? And he said, charge it to the Underhills. So it became kind of a running joke between my friends and I, charge it to the Underhills. And who's paying for this round? Well, but the Underhills are going to have to pay all this debt back. And the question people ask me all the time is, how are we going to pay all this debt back?
Yeah.
Right? It seems, but historically, the way they did it was they printed these coins, and each of these coins has the same glorious leader printed on it. And an unclipped coin was the one on the far left. And then over time, as it was in circulation, people clipped some whatever metal. Maybe this was made of silver.
Silver, right.
They clipped some silver off the edges and round it out a little bit. And then over time, they clip it a little more. So whatever saying was on the outside there in Greek or Latin got lost. And believe it or not, the coin on the right, half of its metal is missing. So you could take that clipped metal, melt it down, and make an entire coin.
Wow.
Okay. And that is essentially, clipping coins is the equivalent of what is called devaluing your currency.
Yeah.
So I borrow from you $53 trillion, devalue my currency. I borrow these from you.
Right.
Right. And then I pay you back in those. Right? Because I've got twice as many of them.
Yes, of course you do.
So it really only costs me $21.5 trillion to pay you back. That's the concept of devaluing your currency if you get too much debt. We've seen that historically. This is an age-old practice. But what's already happening.
But wait, I gotta ask you this though. So you're devaluing the money, so someone's gonna have to pay for it. So of course we say the Underhills tongue in cheek. But what does that mean for like Gen Z? And let's just explore just for a second the mental impact on that. For we have if our currency is devalued, and I know you're going to get to that in a second, what does that mean for our spending and our children's generations and their children's generations?
Right. I really think that the cohort that are the Underhills that we've charged this whole thing to, and it's a demographic reality. The baby boomers were a population, kind of like a rat moving through a snake.
Right.
Okay. It was a large population group. It's not just the United States that has experienced that demographic. It's in Europe. Japan hit it first, right? Europe and the United States are hitting it contemporaneously. And even in a larger way, the rat is bigger. It's more like, a raccoon going through the snake. In China.
Yes.
China has an even bigger demographic problem that it hits a little later than we do, but it's a larger demographic imbalance. And that demographic imbalance ends up weighing heavily on the younger cohort. So the younger cohort in this case are the millennials and the Gen Zs. So the millennials and the Gen Zs really need to maximize, if they have qualified retirement plans like a 401k, they really need to maximize those.
Yeah.
Okay. Those are tax advantage programs. And I think they also are one of the big dividing lines between households that are wealthy and not wealthy is home ownership. So they really need to try to get on that ladder, that home ownership ladder. And we're going to talk about that a little bit later. One of the realities for them, though, is that the devaluation of the currency is their measure of wealth. It's how they get paid. It's mostly what they save their money in. Right now, households in the United States have the lowest exposure to non-dollar assets that they've had in like 35 years.
Wow. Because
we are so enamored with the S&P 500 and the AI stocks and indexed U.S. stocks, that we have sort of turned away, and we really believe strongly in our prospects against non-U.S. dollar prospects.
Interesting.
And that may be something that I allocate against.
So I see Euro stocks on your chart here are up 24% year to date, while the S&P is up 7%. So how should our younger people think about a global diversification without feeling overwhelmed? Because it can be overwhelming with all the politics and the wars and everything else going on.
So the euro has already gone up about 12.5% against the dollar this year. So the devaluation has already begun.
Wow.
And when you translate that is, as I said, that's your wealth.
Right.
That's the Gen Z's wealth. That's that's everybody's wealth who has all their money in US dollar assets, whether it's your house, your checking account, your 401k and stocks and bonds. it is a devaluation relative to another currency. Now, that doesn't feel like much to you, right?
Right.
Because you're buying things in dollars and you have dollars.
Right.
But when you look at how the Eurostock 600 index has performed this year relative to the S&P 500, it's almost 20% behind.
Wow.
Right? And as I said, U.S. investors have the lowest allocation to those types of assets they've had in many, many years. So the Gen Z millennial baby boomers, if the risk is that we devalue our currency and we import inflation, devaluing your currency over time is one component of upward inflationary pressure.
Yeah.
Right? And you will need assets that hedge your wealth against inflation. Housing is one thing that has historically done well against inflation, right?
Yes.
Commercial real estate property has done well. Commodities have done well. It's one reason commodities are doing well on a dollar basis right now, because they're cheaper for somebody who owns euros to buy.
Right, right.
Oil is cheaper. Gold is cheaper. In dollars, gold has gone up a lot, but not in euros. Right?
Yeah.
To them, it doesn't look like gold is creating that much economic value. That's why a devaluing dollar is an asset. You want to hold some commodities. Stocks tend to do pretty well in inflation, except when you get stagflation, where both the economy is doing poorly and inflation is going up.
Yes. So let me ask you this. So, excuse me. For someone out there who is trying to build their wealth, and let's say they want to be there buy their first home or whatever, they see that the government's borrowing. So should families borrow too? What is the strategy, or between taking on debt, and what impact does having so much debt cause that stress to repay? Because that's a big thing, especially when interest rates were starting to go up, and every dollar or every percentage point that interest rates go up equaled real money coming out of your pocket to pay those mortgages.
Okay, we're going to have to unbundle that. There's a lot there, Serina. The first thing,
Okay.
I'm going to talk about interest rates, because
Okay.
interest rates will determine where you can borrow money and get a mortgage to buy a house.
Right.
Right?
Absolutely.
Because most first-time home buyers are going to have to take a mortgage.
Absolutely.
They're not going to buy a house
for cash.
for cash.
No.
Let's assume that, right? So the green line shows you the percentage of our 30-year bonds, the 30-year U.S. government bonds that get bought by foreigners.
Mhm.
Well, what's happened recently is foreigners have sort of pulled back from buying our bonds. It's actually at a very low percentage. They buy almost 2/3 of the bonds we issue. So make no mistake about it. Our deficit is financed by foreigners.
All right. Okay.
Not just us. They realize that this currency devaluation strategy may be in play.
Mm-hmm.
They don't want to lend us those big coins on the left and
Right.
get paid back in the little coins on the right.
Right.
That's already happening. Now, well, what does that mean for me?
Yeah.
Okay, I don't feel, so what? They can go by their own. I don't care. Well, you kind of do care. I'll tell you why you care. The reason you care is the black line is the current yield curve. So on the left is 1 month, and it goes 3 months, 6 months, 1 year, 2 year, all the way out to 30 years. And what you can see is that the black line slopes upward, right? Interest rates are about 4.25% for in your money market fund,
Right.
but it goes up towards 5% as you borrow longer. That's called the term premium.
Okay.
You pay more for longer dated. Now, interest rates a year ago, when the Federal Reserve had the interest rates elevated because they were trying to slow down inflation,
Right.
then they lowered short-term rates, right? What's interesting about the blue line relative to the black line for those 10, 15, 20, 30 rates, by the way, those are the rates that determine mortgage rates, not the short-term rates. It's the long-term rates. Why did the black line go up while the blue line went down? So the Federal Reserve lowered rates.
Right.
The blue line on the left came down to the black line on the left side of it, but the black line went up for the long rates that determine mortgage rates. And mortgage rates have hung out around 6.5%.
Yep.
Right? Well, part of the reason is because those foreign buyers have stepped back.
I see.
And when they step back, right, this is part of the answer. When they step back, the long rates, which if they're buying 2/3 of that, then the next buyer is going to buy them at a little bit of higher rate.
Right.
So there is what we call a term premium, and the term premium for long-term U.S. government debt has gone up. The market is anticipating that all of this debt is going to come to market. This $53 trillion is going to have to be financed, and that it's quite possible that the dollar is devalued. So that impacts. That's how all of that impacts young people who are trying to buy a house. It makes the mortgage rates higher than they otherwise would have been.
Wow. So just to, are there risks or not risks? Are there things where investors can guard against um, uh, having to pay substantially higher mortgages when they're purchasing houses? Or I guess what kind of time horizon should someone who's looking to get into the housing market be looking at?
That's a good question. One of the problems we have in this country right now is that the percentage of home transactions that are first-time buyers has declined to a low point.
Okay.
Less than 25% of home purchases are first-time buyers right now. They're having a harder time getting into the market.
Yeah.
Part of it is the price of housing. Since we've had full employment for a while, and we have had the cost to build a home, land and all the components to build a home have gone up.
Mm-hmm.
As we saw from the last chart, interest rates are higher.
Yep. Tariffs.
Well, tariffs don't play into the housing just yet,
Okay.
but they will,
Okay.
because they're not going to allow building costs to go down. Building costs will, on average, go up.
Right.
Right? And as we saw, the consumer's going to have less, not more money. Most households will have less, not more money when you net out tariffs and the
That's right,
OBBBA, right? So that's not going to help this chart,
No.
which worries me, because the truth is young savers need to maximize their qualified retirement plan,
Yeah.
401ks, right? And they need to get into the housing market because homes do well against inflation.
Yeah.
And if you're devaluing your currency, there's a bias towards higher levels of inflation. Even though 6.5% might seem high, or 6.25% or 6%, it's probably going to have been prudent to buy a house and sign up for a fixed rate mortgage at that level. Now, remember, in the United States, we have a very unique thing. If mortgage rates do go down to 4.5% or 4.75% or 5%, you can refinance your mortgage at that rate.
Right.
With no penalty after a short period of time. I think people, young couples, young families, they're going to need to be aggressive about buying homes. And you have to realize, we'll go back to a period of time in the 1970s.
I was just going to ask you about that.
We're going to go back to that
Yeah.
and talk about it. And there's a little bit of a lesson there. But one of the things you wanted to own during that period was a home.
Yeah.
It was probably one of your best investments, because stocks during the 70s were terrible investments.
Does it matter what part of the country that you live in when you're talking about buying a home? Does it matter by city, by region?
It always matters.
Yeah.
But if you think I understand the micro housing markets,
No.
Some markets are do better than others at different times, and after the fact, you can usually explain why. But there is no question that in some markets, I was looking at the Louisville market the other day, for instance, and home prices have the cost to build a home in Louisville, Kentucky, has gone up between 10 and 13% over the last 24 months.
Wow.
Right? And so what was an affordable market is less affordable. Nashville is even worse. So markets that were affordable have become not unaffordable, but less affordable because home building in the United States, the volume of homes being built, has not caught up with the deficit of homes that were not built during COVID. And because of the cost of building a home, right, and the labor and components required to build homes, we're having a hard time catching up. So it's a very different scenario than 2007, 2008, 2009, where we had homes being built speculatively that weren't being purchased by families to live in. They were being purchased as speculative assets, and they were empty.
Right.
Similar to China, where they don't have that many saving options, so they speculated on real estate, and it ended up being a disaster.
Right.
We now have the opposite problem, where we have this cumulative supply shortage of somewhere between 4 and 6 million homes.
Wow.
We'll probably see more multifamily homes, more townhomes that can be affordable. We probably need more of that type of housing. Smaller single-family homes,
right,
maybe on smaller acreage to make them affordable. But somehow we're going to have to make that deficit up. And that deficit is the reason why owning a home is probably a smart strategy for the next decade. Because we do have a real supply shortage of homes in this country that was partly due to cost issues, and partly due to the logistics of not enough home building resources, labor, coordination, logistics, and partly because of that we've been fully employed and demand for homes. We're also getting kind of a funny thing where millennials did household formation on a delayed basis, but Gen Zs are doing it closer to on schedule.
Yeah.
So you're getting contemporaneous between those two generations household formation.
Very interesting. I am really interesting to see where all of this takes us. We've talked a little bit about how higher rates crowd out priorities. So someone with student loans or mortgage debts are able to reset with refinancing their mortgages when interest rates drop. But you've also cited the 1970s dollar crash as a cautionary tale. Can you walk us through these thought processes that I am spewing at you?
So similar to trying to derive the issue with allocating money to shorting subprime mortgages or shorting credit or hedging credit because credit was overextended. We learned from history by looking back we were seeing signals, we were seeing signs of things. So one of the things that really concerns me now, we're switching to 2025, right?
Okay.
That's what concerned me then.
Right.
Housing doesn't concern me. There's the opposite problem.
Right.
What concerns me, and I keep saying this in all the interviews I do with people, is the third rail is the independence of the Federal Reserve. We must have independent monetary policy, independent from the government.
Right.
Countries like Argentina don't have independent monetary policy, right? And it ends, Venezuela doesn't have independent, no. Zimbabwe. These countries don't have independent monetary policy and central bank decision-making that's completely independent from the government. Back in the 1970s, we did not have that. Arthur Burns was in charge of the Fed, and they refer to this as the Arthur Burns Fed. And William Powell, who runs the Fed currently, has actually made speeches indicating he does not want to be the Arthur Burns Fed. And Arthur Burns' Fed was sort of told by Congress at that time, mostly Congress was very powerful back then, that he could not raise interest rates above a certain nominal level. Like rates could not be above 4% or 5%. That's it, right? Forget about what's happening with inflation
Right.
or employment. But you can't be above that, right? It's not the constituents won't be happy. And it sounds innocuous.
Right.
But what it led to was runaway inflation in the United States.
I remember that.
So, and the funny thing is, we're at about 2.6% inflation right now, which is where it was in 1972 on the left side of this chart. But by 1980, it was over 12.5%.
Wow.
Mortgage rates went from where they are today, 6.5%, to 17, 18%.
Can you just say that one more time?
Mortgage rates, when the Fed was not operating independently from Congress, went to 18%.
That's incredible.
Now, home prices increased wildly in the 70s.
How is
you
that?
wanted to own a home.
Yes.
Because inflation was so high.
But could you afford it?
Cost of building a home was so high that there was no supply coming to the market.
Wow.
So it sounds, yes, your logic path seems like the right one. But what happens is that the supply gets shut off. The supply of new homes gets shut off, and household formation continues. So there's demand for homes, but there's not enough supply. And the cost of building one goes up and up and up because inflation is going up, 7, 8, 9, 10, then over 12%.
Wow.
And the economy was not doing that great. It had a few good years, had a number of bad years. There were a number of recessions during this period. And so the stock market really did kind of lousy. And that was a period referred to as stagflation, a stagnant economy with accelerating inflation. There are elements of that today that are present. Now, I'll tell you why it won't get that bad. Okay. And the reason it won't get that bad is because back then, wages were indexed to inflation.
Okay.
So you really had kind of a real negative feedback loop where inflation was high, so all the wages went up. Today, you don't have wages that are set to inflation. In fact, if we have a recession, people will lose their jobs.
And also, our Fed is independent now as opposed to back then, right?
That's coming into question under the current administration.
Okay.
There's been the termination of the person who was in charge of calculating the jobs number, and the conversations between the administration and Chairman Powell have indicated that the administration would like to dictate where interest rates are.
Oh boy.
And that takes us back to the Arthur Burns Fed.
Yeah.
Now, what happened, and we didn't have the euro back then.
No.
But we're now back to the clipped coins issue.
Mm.
And this is why having a larger portion of your portfolio in non-dollar assets, emerging markets, stocks, European bonds, and European stocks, things of that nature. The Deutschmark went up 47%, meaning the dollar lost almost half its value. Remember our clipped coin?
Yes.
That was half the size?
Yes.
That's what happened.
Interesting.
That's exactly what happened. The dollar got clipped to half its size against the Deutschmark during that stagflationary period.
Wow. And
that contributes to inflation.
Yeah.
That because anything you have to buy from Germany, right?
Sure.
Or the Germans can pay a lot more for commodities. They'll drive the price of commodities up. But for us, with our little coin, right? We have to pay more of those little coins for physical commodities, whether it's lumber or soybeans.
Right.
Copper.
Yeah.
Just think of all these things. So this is sort of in play. This is something that I'm now starting to think about. And how do I recommend asset allocations against not this being a certainty, Serina, but these characteristics being an increasing probability.
Okay. So with that said, so this impact on currency and seeing how history can repeat itself and seeing where the writing on the wall could possibly be headed. What could we do to stay above this inflation? Can wages, like they had in the past, can we just drive interest rates down based on based on our wages? Couldn't we do something where we can change the course of things before it's too late?
That gets us back to the subprime mortgage crisis.
Okay.
The goal of and it started actually under George H. Bush 1, was we really started focusing on that issue that I mentioned earlier, where household wealth can be divided into two categories: those that own homes and those that do not.
Okay.
And policymakers said, you know what? We need to have more people in that camp that own homes.
Okay.
So let's make it easier for them to buy a home.
Hmm.
So let's reduce the stringency to get mortgage approval. Now, it started out in kind of a small way, and there really wasn't that much uptake initially. Subsequent administrations sort of leaned into that policy initiative because it sounded good. I mean, it really sounded good. Hey, more people are going to own their homes.
Yeah.
This will improve neighborhoods. This will improve stability of the household. This will improve household wealth. And so we pushed from 64% of households owning homes up to 69%.
Wow.
Unfortunately, that 5% couldn't pay their mortgages.
Mm-hmm.
Right?
Yeah.
And
That's a
so
problem.
doing something that sounds constructive turned out to be a problem. Now, what's going on right now is that, and this is unusual, U.S. and European inflation expectations are diverging. Europe's are going down and the U.S. are going up. This is in part due to the tariffs. It's in part due to labor supply constraints we're going to have because of changes to immigration policy. It's due to, in part, the depreciating dollar. And so we have more inflationary pressures. They're going to show up on a delayed basis. It's more likely we see incremental weakness in the economy before we see the inflation showing up. But it's already out there in the expectations. And that's one of the reasons we saw those longer term rates that determine mortgages, the black line in the earlier graph, being higher than they were last year, because we had expectations for lower levels of inflation a year ago on a forward-looking basis. Now we have expectations for slightly, not the kind of inflation we saw in the 1970s yet, but certainly 1% higher than we see right now. There's also a cost to uncertainty, and we had a lot of uncertainty. The administration has had some policy changes, which people talk about, and after a while they stop talking about it because it happens quite often. I've noticed that there's almost sort of a numbness to it after a while. But some economists have looked at, this line shows that, remember that GDP number we talked about, which is our economic growth.
Right.
Uncertainty, and these are quarters, 1 quarter, 2 quarters, so these are 3-month increments. But the longer you have uncertainty, the more you create lower GDP, you subtract from economic growth. So if it only happens for 1 or 2 quarters, you lose about 0.6%.
Right.
But if it goes on for a full year, you lose 1 to 1.5%. So the longer, and how does uncertainty manifest itself? It manifests itself in businesses not moving forward with a project.
Right.
What we're seeing in the labor market is that businesses aren't hiring. They aren't firing,
right,
but they aren't hiring.
Yeah.
And so those are what I would say decisions that are not being made. People in commercial real estate tell me that projects have been mothballed. They're not going forward with those projects. There are projects where the cost due to the tariffs, one of my friends is redoing a fancy store on Fifth Avenue. He ordered these big glass sheets because they sell a very high-end product you have to show off with special lights.
Yeah.
The kind of bling you wear.
Right, of course.
And the glass has extruded aluminum frames, and extruded aluminum has not only is there a 15% tariff for that country in Europe where it's made, but aluminum, it's an extra 25%.
Wow.
So when he went to pick up the big glass frames, of which he had millions of dollars of these, the tariff bill was 41%.
That's insane.
So he has people who have similar projects who are holding off.
You can't sustain a business as you're continually losing money. I mean, for so long to make up that deficit, it takes longer and longer and longer. The longer you try and stay afloat, it's just like, as an individual with credit card debt, if you keep just paying the minimum payment, that debt is going to keep growing and growing and growing, and until you just are paying back hundreds of dollars more than you borrowed initially, or thousands, or depending on what the amounts are. But how are we going to fix this?
Well, he had to pay the tariff and turn around to the customer and say, here's the tariff bill.
That's who's going to pay for it.
And so the customer had to pay for it.
Yeah.
Walmart's CFO said in no uncertain terms that the customers were going to pay for the tariffs on the increase in prices in Walmart, right? And those are those lower income deciles we saw earlier, right? And they're going to pay their share of the tariff. So one thing that I'm seeing already is one of the things that was really sticky. Remember we had the inflation after COVID?
Yes.
A lot of it was what we call services inflation. Remember when the electrician and the plumber would come over and you feel like you were getting absolutely
railroaded.
It was a shakedown, right? It was a shakedown. Those were services, and those were services inflation. And you were right to feel that way because services inflation was running up during that 2-year period up close to those 1970s levels.
Wow.
Right? Goods inflation was actually the grocery store, and the price of goods was actually much more muted. Rents actually were a problem.
Yeah.
Rents went way up during that period.
They're still high.
In certain markets, yes. In some markets, there was overbuilding. In the southeast of the United States, they're actually falling.
Oh, really?
Yeah,
Okay.
A lot of people don't know that. But what we've seen recently, the green line on the far right, is all of a sudden, services inflations are jumping up again. This is a forward indicator. This is the kind of stuff I look at. You don't see it yet, right? But you're going to see it because it's baked into the price of a lot of things that you buy or services you look for. So we're already seeing elements of that inflation starting to come back. And services inflation is really hard to get rid of once it sort of gets some momentum.
Gets its teeth in things. Yeah. Interesting. All right. I want to ask you a couple of questions. I want to wrap this up, and then I'm going to ask you some fun questions. But just in general, can you just give us your thoughts as to what we can expect next from the markets?
The markets. You know what I always say when I speak at conferences, they have me get up at, what they do is they serve, there's all these people in a room, there's 10 or 12 people at a table, and it's an industry, right? Like the National Manufacturers Conference or the National Real Estate Developers. And I meet some of the people, and I always ask who the big personalities are, because then I can kind of razz that person from the stage, and everybody laughs. But I get to eat my salad, and then they say, you got to go up on the stage now. So I never get to eat the chicken or salmon or steak, whatever they're serving. I never get dinner. I always just get the salad. So speaking is a good way to have a diet. It's it's a really great forced diet. But see if I've got anything to talk about. Yes, I do. So the people, when I get up there, they always ask me, invariably I get through my little talk and my slides, make a lot of jokes, razz the big wheel in the outfit, and then they ask me, okay, what's going to happen to the markets?
Yeah.
And I always make a joke, and I say, after the Big Short, I had this crystal ball, and then I dropped it and broke it. So now it's so much harder for me to answer the question, right? People they assume I have sort of a crystal ball.
Yes,
right?
of course.
It really is triangulating all this information in my head, going back to the Artful Dodger and 15-year-old kid on the floor of this exchange. I'm trying to get a feel for the body language I'm seeing in the marketplace. Right? So we do see that services inflation is rising. We do see that the dollar is going down. We do see that there are concerns about independence of the Federal Reserve. These are things I'm observing.
Okay.
Right? This chart actually shows earnings growth. The red and the blue line are roughly the same thing. You just adjust the blue line and you get the red line by subtracting the level of inflation.
Okay.
But they're roughly the same thing, and it shows the growth of the S&P 500's earnings year over year. So our earnings growing 20% a year or 10% a year, or our earnings flat year over year or shrinking.
Right.
Right. So going into the end of 2024, earnings growth was accelerating. And it looked like we were going to have sort of a 12% earnings growth. And that's kind of a healthy growth rate for earnings.
Sure.
Right? Earnings are still growing. We had a very robust second quarter report for earnings. But the forward earnings now are projected to only grow at 8%, not 12%. So it's the sort of momentum, earnings growth momentum is coming off, right? I think there was probably a lot of accelerated economic activity in the second quarter. Whenever I ask somebody, hey, did you buy something before the tariffs kicked in? And you thought, did you buy a bunch of stuff?
Of course.
I haven't talked to a single person who hasn't said yes to that question. I think in the second quarter, we had a kind of a beat the tariff consumption bump.
So it's more of an anomaly.
It's temporary.
Yeah.
It's temporal. And I'm thinking we're going to get a slowdown, but we aren't going to see it until we start seeing third quarter estimates and forward guidance on earnings. And that is what concerns me, is that blue and red line could start migrating down back towards lower year-over-year earnings growth. The stock market's trading at a pretty high multiple to earnings.
Yeah.
Which, if you're paying a high multiple of earnings, you should get a lot of growth. You should get a lot of earnings growth, right? If earnings growth starts to come down and disappoint, the level at which the market is trading is susceptible. Now, I think the market could go higher from here in the near term, because as the economy slows down, there's going to be reason for the Fed to continue cutting rates.
Yep.
1/4 point in September and 1/4 in December. That's what's expected. I think that's probably a pretty good bet.
Yeah.
On balance, that will tend to support the market through the end of the year.
Okay.
What concerns me is these other longer term effects. The Fed cannot impact services inflation.
Right.
It cannot impact earnings dynamic. It cannot impact that consumer sentiment that, as we saw, is low. And they may pull back. They may know they have to save more if prices are going up.
Yeah.
And they can consume less, and everything's going to cost more at Walmart or at Tiffany's.
Right, right.
All along the food chain, the consumer's going to buy, maybe they spend the same amount of money, but they're going to get fewer units. And they're probably going to have to shift more of their spending into what I would call non-discretionary, things they have to buy.
Yep.
So watching this, I think between now and year end, these interest rate cuts that's why the market is staying elevated right now. Again, still far behind the Eurostock 600 because of the currency and the fact that Europe's inflation expectations are coming down. They have more room to cut. They have more room to do fiscal stimulus than we do. But that is something I'm concerned about. In the near term, I think you can be reasonably constructive that the markets aren't going to crash. Medium and longer term, beyond the end of this year, then I'm going to get a little bit more concerned about owning a market that has declining growth prospects
Yeah.
at very high valuation.
Multiples,
They
yeah.
use the term, another way of saying high multiple of earnings is high valuations.
Yeah.
We are at the higher end of the valuation range historically. We're not way above it, but we're just at the higher end of the range.
I have a quite that's crazy. I mean, it's really enlightening to see where the markets can go, and I'll be really interested to see how things shake out. But I'm going to lighten it up a little bit right now, and I'm just going to ask you what the best money advice you ever got was.
I had an answer to this once, but I forgot it. People have told me some simple things. I think there was this guy named, he was this guy in San Francisco I worked with a long time ago at Morgan Stanley. And he was very proper. He belonged to the Olympic Club, which was like a men's club, and he used to go up to this place up in the Redwood Forest called the Bohemian Club Retreat. That's what it was called. It's called the Bohemian Club. And it was like an old school club. They'd go over there and have lunch and have, gin martinis. And he said to me, you really have to just save and invest.
Yeah.
You're going to have a lot of friends that are going to live high on the hog. Live reasonably, but save. Really save money. Don't save money because you spend it, buy something that's on sale. Save money. Buy a house. He said, you will have so many friends that think that the gravy, whatever, they may be having a good year, it's going to go on forever, and it won't. And you'll see that it's that old, he said, the old story about the grasshoppers and the ants, where the ants,
busy working,
saving, putting away everything, building their house. And the grasshoppers are lazing around in the sunshine, right? And then the grasshoppers starve to death and die when the season changes, and the ants survive. I think that advice, and I kind of followed that path.
Yeah.
And it kind of translated to family stability and everything else around it. And I know you talk about that all the time, right? So I think it spreads a lot of positive things outward in your circle.
I think that's amazing. And I got to tell you, Michael, this was a master class. I've learned so much from you just in this 1 hour. And I have to tell you that we are so thrilled to announce that that guy is lit is going to be a new segment on SOSradio.live, where Michael is going to drop short takes on markets, risk, and opportunities that are available. And you should definitely subscribe to SOSradio.live if you're not already a member. And I want to thank you so much for joining our show. But I like to close every segment with one of my son Scott's poems. And today's poem is called The Struggle. And I've got to put my glasses on because I can't see it. But here we go. The way I feel can't be described into words or rhymes. Get with the times. The kids I once knew are developing, not relishing in the innocence they once had. I can't handle the weight on my shoulders, as heavy as boulders, that pull me down to the ground, make me pin flat down. Losing air as lies fill my lungs, my body speaks the opposite of my mind. I can't take control of the situation at hand, for my body and mind don't communicate. They can't agree on a compromise, so therefore can't synchronize. I still get blown away by how my son's poetry can transcend just different topics. I mean, you could take this and even put it into the market and how it can totally affect you and deflate you and really wreak havoc on your body. But I want to thank you for joining us today on SOS Stories of Survivors, where survival sparks the soul. And please rate us, donate, and subscribe. And we'll see you next week. Thank you, Michael.
Thank you.